Today is April 11th, 2026. This week, the AI got the direction right. But that is not the whole story. Using a conservative review method, next session open as the entry reference and Friday's close as the exit, the US book still finished positive overall. The clean winner was Vertiv, the weaker call was GPCR. And the big lesson is simple. Fresh catalysts paid, repeated chasing did not. US markets were supportive too. Stocks posted a second straight weekly gain, and AI hardware stayed strong as investors leaned back into semis and infrastructure names. Let's start with what worked. Vertiv was the right call, not once, twice. The first VRT setup was the best one. The stock had a clean chain of support behind it, capacity expansion tied to AI data center cooling, a fresh RBC target raised to $300 on April 8th, and a market that was clearly rewarding AI infrastructure leadership. That is real signal. Not narrative, not hope, real signal. The April 7th call had the best edge. The April 8th call still worked. Both were valid because the thesis, the catalyst flow, and the tape were all aligned. That matters. Because when the model is at its best, it is not just finding good companies. It is finding freshly confirmed leadership. That is exactly what VRT was this week. Now the mistakes. This is the important part. GPCR made money, but I would not call it a clean win. The thesis was only partially validated. Why? Because the real company-specific catalyst had already fired on March 16th. Then on April 1st, Lilly's oral weight loss pill approval helped reheat the theme. By April 6th, the new information edge was gone. So yes, the stock still bounced. But this was no longer first-order alpha. This was a continuation trade. The issue was timing. And then there is the more subtle mistake, repeating VRT too late. The April 9th VRT call still closed green, but the edge was clearly fading. A model that does not recognize signal decay starts to confuse same direction with same opportunity. Those are not the same thing. So the critical mistake this week was not a dramatic blowup. It was overstaying a good idea. Here is what the model learned this week. First, fresh catalyst beats stale momentum. Every time. Second, leadership repetition needs a decay rule. The first signal deserves size. The second, smaller size. The third should be a probe or a skip. Third, cross-market and cross-theme mapping has to stay clean. A stock going up does not mean the model's reasoning was correct. That is dangerous. This week's process errors were mostly self-inflicted. Macro was not the problem. The market was helping. So what changes next week? I stay risk-on, but I get more selective. I want event-driven setups first, not late extensions. That means fresh earnings, capacity updates, and real infrastructure demand. For position sizing, the rule should be simple. First signal, full size. Second, half size. Third, quarter size or no trade. That is the upgrade. This week proved the model can find the right theme. Now it needs to get better at when to act, how much to size, and when to stop.